Imagine, if you will, the year 1637. An unprecedented economic event is unfolding: the tulip crisis. In the heart of the 17th century, the Netherlands was swept up in a frenzy over tulips. Yes, you heard it right, tulips, those colorful, pretty flowers. The prices of tulip bulbs skyrocketed, driven by speculators looking to make a quick fortune. This event, known as the tulip crisis, was the first recorded speculative bubble in history. However, like all bubbles, it burst, leaving many bankrupt and creating an economic crisis. But even as the dust settled on the tulip crisis, another groundbreaking event was taking shape. 10 years before the tulip crisis, in 1602, a remarkable company was born: the Dutch East India Company. This company was the first to issue shares to the public, marking the establishment of the first publicly traded company. This might seem like a small step, but its implications were far-reaching. By selling shares to the public, the Dutch East India Company effectively spread the risk of their ventures among a large group of investors, rather than shouldering it all themselves. This idea was revolutionary. It allowed businesses to raise substantial amounts of capital, and it gave everyday people the chance to own a piece of a company and share in its profits and losses. This was a game changer. It laid the groundwork for the stock markets we know today, where anyone can buy and sell shares in a company. The Dutch East India Company set a precedent that would be followed by companies worldwide. So, the next time you check your stock portfolio, remember the humble tulip. It was amidst the turmoil of the tulip crisis and the innovative thinking of the Dutch East India Company that the concept of a publicly traded company was born. And thus, the concept of a publicly traded company was born, paving the way for the emergence of modern stock markets. Fast forward to the late 18th century. The New York Stock Exchange emerges, revolutionizing the world of trade and investment. As the world became more interconnected, the need for a centralized place to trade commodities and securities became apparent. This led to the formation of stock markets, which played a pivotal role in shaping the world's economy. These were not just bustling hubs of commerce, but also the birthplaces of unique financial instruments. In essence, stock markets are exchanges, platforms where buyers and sellers come together to trade shares. When a company decides to go public, it lists its shares on a stock market. This process, known as an initial public offering, or IPO, allows companies to raise capital from the public. In exchange, investors receive a piece of ownership in the company, with the hope that the company will grow and their investment will appreciate. But how did these stock markets function? Well, up until the last century, it was all done manually. Picture this: a bustling trading floor filled with brokers frantically waving their hands and yelling out orders. Each trade was recorded on paper and then manually processed. This was not just a place for the exchange of stocks, but a physical manifestation of the ebb and flow of the economy. Yet this system was far from efficient. It was prone to errors, delays, and often lacked transparency. There were no instant updates, no real-time tracking of prices. A trader in London would have no idea about a price change in New York until the next day. But as the world was about to step into the 20th century, a new era was on the horizon. The manual mechanics of the stock market were about to be challenged by something much more powerful and efficient. The stock market, once a complex manual system, was about to be transformed by the advent of the digital age. As technology advanced, so did the stock market. Welcome to the era of online brokers. The dawn of the internet presented a seismic shift in the trading world. Suddenly, trading was no longer confined to the hustle and bustle of the trading floor, or the exclusive realm of Wall Street professionals. Instead, the digital revolution, led by the rise of online brokers, brought the stock market to the fingertips of the everyday individual. This was a game changer. It meant that anyone with a computer and internet connection could become an investor. The barriers to entry were significantly lowered. No longer did you need a personal broker or a hefty bank account to invest in stocks. The rise of online brokers democratized investing, making it accessible to everyone. These platforms offered user-friendly interfaces, educational resources, and even robo-advisors to guide novice investors. It was a stark contrast from the days where financial jargon and complex processes made investing an intimidating venture. Online brokers also offered the advantage of speed. Trades that once took several minutes or even hours could now be executed in mere seconds. This offered investors the ability to react quickly to market changes, a crucial factor in the fast-paced world of trading. But it wasn't just about speed and accessibility. Online brokers also provided transparency. Investors could now track their investments in real time, monitor market trends, and make informed decisions based on comprehensive data. While online brokers have indeed democratized investing, it's important to remember that it's not without its challenges. The ease of access also means it's easier to make impulsive decisions or get swept up in market hype. Additionally, the digital nature of online trading also exposes investors to cybersecurity risks. Despite these challenges, the impact of the digital revolution on trading is undeniable. It has transformed the way we invest, making it a more inclusive and accessible space. The once exclusive world of investing was now open to all, but with great opportunity comes great risk. Investing in equities can be a lucrative venture, but it's not without its perils. Now let's peel back the layers on this statement and delve into the world of equities. When you buy a share, you're buying a piece of a company, making you a part owner. The advantages to this are twofold. Firstly, as an owner, you stand to profit from the company's success. If the company does well, the price of your shares could increase significantly, potentially offering high returns on your investment. Secondly, some companies distribute a portion of their profits to shareholders in the form of dividends, offering a regular income stream in addition to potential capital appreciation. But let's not forget, the world of equities is not all sunshine and rainbows. There's also a flip side to this coin: the risks. The stock market is notoriously volatile, meaning share prices can fluctuate wildly in a short period. This volatility can potentially lead to substantial losses, especially if you need to sell your shares when prices are low. Moreover, when you buy shares, you're essentially betting on the company's future success. But companies can and do fail. If the company you've invested in goes under, you could lose your entire investment. This is why diversification, or spreading your investments across a variety of companies, is often recommended as a way to mitigate this risk. Furthermore, investing in equities requires a level of knowledge and understanding that not everyone possesses. It can be a complex and time-consuming endeavor, requiring regular monitoring of the market and your investments. Not to mention, it can be emotionally draining to watch the value of your investments rise and fall. But don't let these risks deter you. Instead, use them as a reminder to approach investing in equities with caution, patience, and a well-researched plan. Remember, high potential returns often come with high risks. Armed with knowledge, investors can navigate the turbulent seas of the stock market and potentially reap substantial rewards. So are you ready to set sail? As we've journeyed through the history of the stock market, several key points stand out. From the tulip mania of the 17th century, we've seen how the first seeds of trading were sown. The birth of stock markets in the centuries that followed marked a turning point, facilitating a new era of economic expansion and wealth creation. Fast forward to the last century, the transformation from manual to digital trading has been nothing short of revolutionary. Today, online brokers have democratized investing, making it accessible to everyone. The allure of equities lies in their potential for high returns, yet it's important to remember the inherent risks involved. Volatility, market downturns, and the possibility of total capital loss are all part of the equation. But despite these risks, the stock market, a testament to human ingenuity and ambition, remains a powerful tool for wealth generation and economic growth.